This opening slide introduces Equinox Gold as a transformed, North America-focused producer. The core idea is that the company has moved away from a broad multi-asset growth model toward a more focused portfolio built around Greenstone and Valentine. That matters because the investment case now depends less on acquisition-driven growth and more on operational delivery, margin quality, and free cash flow. Investors are being asked to assess whether this new version of Equinox can translate a stronger asset base and cleaner structure into a higher valuation. The stock looks more investable today, but the market still wants proof that the new platform can deliver consistently. This slide explains today's strategic positioning. Equinox describes itself as a top quartile producer in the making, with major operating anchors at Greenstone, Valentine, Mesquite, and the Nicaragua complex. Longer-dated optionality comes from Castle Mountain and Los Filos. The company has been reshaped by the Calibre merger, the Brazil asset sale, and a clear emphasis on free cash flow, debt reduction, and organic growth. That is important because Equinox is no longer being judged simply on size. It is increasingly being judged on the quality of its ounces, the durability of its balance sheet, and whether management can convert this restructuring into a more premium operating profile. The 2025 metrics show why management calls it a transformational year. Equinox produced 922,827 ounces of gold, generated $2.71 billion in revenue, and delivered $1.34 billion in adjusted EBITDA. Just as important, the company reduced debt by more than $1.1 billion since Q2 2025. These are significant numbers because they show that Equinox is now operating at much larger scale while also improving its financial position. For investors, this slide is a reminder that the story is no longer theoretical. The company now has real size, real EBITDA, and real balance sheet improvement. The key question is whether those gains can be sustained through stronger operating execution in 2026 and beyond. This slide highlights the cleaner balance sheet and capital return story. Equinox ended 2025 with about $430 million in cash, and by early 2026, net debt had fallen to roughly $75 million. That is a major improvement and gives management much more flexibility. The company also launched an inaugural quarterly dividend of $0.015 per share and added a share buyback program. From a market perspective, those moves are important because they signal a shift from repair mode to capital allocation mode. Investors generally reward miners that can both reduce debt and start returning capital. This slide makes the case that Equinox is entering that phase, provided operating performance remains stable. This is one of the most important slides in the deck because Greenstone and Valentine now define Equinox Gold 2.0. Greenstone produced 223,843 ounces in 2025, including a strong Q4 ramp-up to 72,091 ounces. Mill throughput averaged 23,859 tons per day, and the plant achieved nameplate 27,000 TPD for 30 consecutive days in December. Valentine poured first gold in September 2025, achieved commercial production in November 2025, and produced 23,816 ounces in 2025. It was running at about 90% of nameplate throughput in Q4, with full capacity expected by Q2 2026. These two mines are critical because they are supposed to drive better production quality, stronger margins, and greater investor confidence. This slide presents 2026 guidance and the shift toward better quality production rather than maximum volume. Equinox guided to 700,000 to 800,000 ounces of gold production in 2026, with AISC of $1,775 to $1,875 per ounce. Production is lower than 2025, but that is mainly due to the Brazil asset sale and the suspension of Los Filos. The key point is that management is emphasizing quality of ounces and margin potential. Valentine is expected to be a low-cost standout, Greenstone is expected to keep improving, Mesquite remains mature and steady, and the Nicaragua complex continues to support cash flow. This is more of a portfolio optimization story than a headline production story. This slide explains why Equinox's reserve and mine life profile now looks more investable. The company reports a total proven and probable reserve base of 19.1 million ounces. Around 70% of 2026 estimated production is concentrated in North America, and roughly 80% of consensus NAV is tied to North American assets. The three core mines contributing about 70% of production have an average mine life of roughly 13 years. That matters because long mine life and jurisdiction quality are key drivers of valuation in the gold sector. A company with longer-lived, more concentrated core assets is usually easier for the market to underwrite than one with a fragmented, short-life portfolio. This slide focuses on the organic growth pipeline, which management presents as more than 500,000 ounces per year of combined potential. Valentine Phase 2 offers around 225 KOs per year and looks like the most credible near-term growth option. Castle Mountain Phase 2 adds another 220 KOs per year, but it remains constrained by permitting and regulatory timing. Los Filos expansion has the biggest nominal upside at 280 KOs per year, but it is clearly the highest risk option because of community agreements, social license, and ongoing suspension issues. Investors should separate probable growth from optional growth here. Valentine appears the strongest near-term expansion candidate, while Castle Mountain and Los Filos remain valuable but less certain. This valuation slide is central to the mispriced argument. Equinox trades at about 0.98x P/NAV on analyst consensus and about $16,930 of enterprise value per ounce of average 2026 to 2028 production. The company also points to roughly $1 billion in average annual free cash flow estimate for 2026 to 2028. External analyst sentiment is broadly positive, ranging from moderate buy to strong buy. The key point is that the market sees potential upside, but the company has not yet earned a full premium multiple. Re-rating depends on execution, especially at Greenstone and Valentine. So the stock may look undervalued, but the upside is conditional, not automatic. This slide lays out why some investors remain cautious. First, Greenstone's early ramp-up missed expectations, so the market still wants harder proof of consistent delivery. Second, consolidated AISC is improving, but it is not yet clearly best-in-class. Third, Valentine must prove it can sustain reliable production beyond its early ramp-up phase. Fourth, Los Filos remains an uncertainty and limits how much value the market gives that part of the portfolio. Fifth, the company still has a large basic and diluted share count, which makes per-share re-rating harder. Finally, the stock remains very sensitive to gold price moves, so while Equinox is stronger, it is still a show-me story. This slide reminds investors that Equinox is still fundamentally a gold price-levered company. In 2025, the realized average gold price was $3,465 per ounce, which provided strong support to margins. If gold remains strong in 2026, Equinox has four major opportunities: eliminate remaining net debt, self-fund internal growth, support dividends and buybacks, and potentially re-rate toward top quartile peers. If gold weakens, the business becomes much more execution-dependent, especially for higher-cost assets. This is a key point. The company is structurally improved, but the market conditions still matter enormously. Gold strength makes the transformation easier. Gold weakness would test the resilience of the new portfolio. This slide summarizes management and market expectations. Management wants Greenstone and Valentine at full capacity by roughly mid-2026. It also appears to expect that remaining net debt can be eliminated in 2026, while capital returns through dividends and buybacks continue. Analysts seem to expect stronger per-share cash flow, a cleaner valuation after the portfolio reset, and room for a re-rating if operational delivery stabilizes. But the market is not fully convinced yet. The company's new structure is recognized, but investors still want proof of consistency. In other words, the setup is better, but credibility must still be earned quarter by quarter. This bull versus bear slide makes the investment debate clear. In the bull case, Greenstone continues improving, Valentine ramps smoothly, net debt falls to zero, and higher return projects like Valentine Phase 2 support a major re-rating. In the bear case, Greenstone disappoints, Valentine ramps more slowly than expected, Los Filos issues persist, and weaker gold prices pressure margins. This is important because it shows how much the next phase of stock performance depends on operations, not just gold prices. Equinox has already improved its structure. The next step is proving that the operating platform can consistently deliver enough to justify a higher valuation. The final conclusion is that Equinox Gold is clearly a stronger company than it was before the portfolio transformation. It now has two important Canadian cornerstone assets, a much better balance sheet, visible free cash flow potential, and a real capital return story. But valuation still depends on execution. The market wants proof that the company can produce consistently, meet operational targets, and convert stronger assets into stronger per-share results. That is why the next few quarters are so important. For investors seeking leveraged exposure to gold with improving fundamentals, Equinox looks attractive. For more conservative investors, it still needs to prove that this transformation can turn into repeatable operational success.